So let's continue with Chapter 3. We had a bit of an introduction last week on FICA and SECA. Quick review. SECA, Self-Employment Contribution Act, is for the person that is self-employed and is paying both parts of FICA, right? So employee plus employer. And of course, FICA is for an employee. I think we got up to the screen where we were discussing taxable wages. And again, this chapter is on FICA, that's 6.2 plus 1.45, and then of course it's paid by both parties. So taxable wages is basically everything. It's cash, it's your bonuses, wages and salaries obviously, but it's also some non-cash items, and this is where it gets a little bit tricky. So if your employer provides you, for example, meals and lodging for their convenience or for the employee's convenience, that's going to show up on your W-2. So for example, like in Silicon Valley on the Facebook campus, they have 4-star chefs. I mean, it's just unbelievable the kinds of things they do to recruit young minds to these high-tech campuses. So the value that every day I go through, I have an organic meal, I have a $4 kombucha, I'm going to scan my code, right? And the value of that meal is actually taxable to me, right? They're not giving me cash, but I'm not having to buy and pack a lunch. Same thing with they do my dry cleaning and they do my pet grooming and they do all these other services that are part of recruiting. Those are non-cash taxable benefits, aren't they? And they show up on your W-2 and you pay FICA on them. So they're not really free, are they? Also gifts, stock payments, again, it's a great example. You work for somebody like a Tesla or an Amazon or a Microsoft or an Alphabet. You're in mid or upper level management. A significant part of your compensation package is going to be stock and stock options. Those are taxable. You pay FICA on those. You pay FIT and SIT on those. They're not cash. You can convert them to cash when you so desire. What if my company gives me a corporate car to use? Here, Lise, take this brand new Land Rover. You work for my medical device company. You need to travel all over the inland Northwest in the middle of the winter, visit hospitals, take doctors out, for lunch, what have you, sell them on these new devices. We're going to give you this car, this $60,000 car to use. Okay? And when I leave, I've got to give it back. But you don't have to bring it back on Friday afternoons. You can use it for personal use. I am taxed on the miles that I use it personally. There's a chart the IRS publishes on this irs.gov. There's a chart that is published for basically every vehicle out there, and it gives you a per mile amount. So at the end of the quarter, I say I drove that Land Rover 6,000 miles for personal use and 8,000 miles for business. Those 6,000 miles are multiplied by a rate, and it's going to be pretty high if it's a brand new $60,000 rig. It's probably going to be 60, 70 cents a mile. That's taxable to me. I pay FICA and FIT and SIT on it. Okay. It's going to be different if they've given me a 1972 Hornet, right? That's going to be 2 cents a mile. Vacation pay, I pay taxes on if they pay life insurance for me and the face value. In other words, if I die, my beneficiaries get more than 50 grand. The premiums on that are taxable to me. And then on page 3-6, there's a whole laundry list of them. You should look at that and see, because in Missoula, Montana, our comp packages are pretty straightforward. But you start getting into urban areas and the way, again, that they recruit young talent, or not just young talent, but is through this wide swath of these kinds of non-cash benefits. Okay, tips. We've talked about tips before. If I make more than $20 a month regularly in tips, I am going to pay FICA on them. How does my employer find out how much tips I've received? I have to tell them, don't I? And it's called a Form 4070. Or there's lots of different ways to do it. In most systems now, when you check out, like bar or restaurant situations, when you check out at the end of the night, you can't check out your till or, cash out your number or whatever until you input your tips. So they just accumulate it digitally. But I've got to pay FICA on my tips. Let's try a quick example. I guess I'm going to have to do this on Excel since I'm recording it. Let's try an example just to reinforce this concept. And as I'm getting this loaded, you can just write these facts down. So let's say that my annual wages are $29,000. And I'm paid biweekly. Annual wages, $29,000. I'm paid biweekly. And I report tips of $456 for the last pay period. Can you calculate my gross pay, please? And then just pretending I don't have any fit or sit, can you calculate my gross pay, subtract my FICA, and get to my net pay? So for one pay period, I want you to get my gross pay minus my FICA. Oops. And get me to my net pay. Okay, what was the tricky part about this? You've got to make sure that you calculate the FICA on the tips. In other words, you're not paying her the $456. You're just paying her $29,000 divided by 26, right? But you've got to calculate FICA on the wages plus the tips. Make sure you understand that. Students have a tendency that they want to give her the $456. Well, no, that's her tips. She's already got that. You don't pay her that. But you do have to calculate 7.65% of the gross pay plus the $456. And if she had federal income tax and state income tax and all that, which she would, you would also calculate those amounts on tips plus gross. Does that make sense? Okay. Okay, so we just talked about things that are specifically included. What's specifically excluded? Well, if the employer provides meals and lodging for the employer's convenience, it doesn't show up. For example, I have a ranch up on the High Line, and you know, the folks that work on my ranch live there because there's nowhere else to live. I mean, I'm isolated, right? So that's for my convenience. I can't get anybody to come work for me if I don't give them room and board because there's nowhere else for them to live. Then that's not going to show up on their W-2. So the question is, who's benefiting from it? And the example on the Facebook campus, that's clearly to recruit and retain employees, right? That's for their convenience. Okay, in the second example on the ranch, that's for my convenience. So I'll make that clear. You won't have to make that call. I would make it clear. Sick pay. So this is short-term disability. 6 months I've been off. I've been injured, or I'm going through chemo, or whatever the situation may be. And then I start getting payments. Then I do not have to pay FICA on those short-term disability or sick pay wages. And then if I'm a reservist activated for more than 30 days, the differential between my base pay as a military, deployed military personnel and my salary is exempt from FICA. Any amount that my employer puts into my pension plan, I don't have to put FICA on that. So for example, in that last example where what was she making, $1,115 or something? If the employer puts in 3% of her gross into a pension plan, she doesn't have to pay FICA on that. And then also educational assistance, tuition reimbursement, up to $5,250 a year. If my employer pays up to $5,250 a year in tuition for me, as long as it's a non-discriminatory plan, in other words, it's open to everybody in my company, then I don't have to pay FICA on that. Okay, so this just says that what does that say? Okay, so did we agree we're using the 2017 numbers? Okay, so this is the cap that we're using, 127.2, which is the 2017 numbers. 6.2% up to the cap, matched by the employer, right? 1.45% for Medicare, is that matched? Yeah. Is that capped? No. And then you've got that weird little caveat with OASDI of what?
0.9% on the employee portion over $200,000 a year.
If single, and $250 if married filing joint. Tax laws, you never can really just end the sentence after a couple words. And then usually, I'm just starting into tax season, so I've been doing some research on some stuff, and it's like, you read this whole page and you're like, got it. And then, we were always coached to do this, you know, going through grad school. You know, you got to read the code section before it and the code section after it. And the code section after it's always, except for when, and then it's like, oh, for Christ's sake, just tell me what to do here. It's late. So 0.9% in excess of 200,000 if the employee is single, 250,000 if the employee is married filing joint. I don't think they even have that in your book, but that's the law. And it says, although it may be rescinded, see as we go to press, it was not rescinded in the Tax Cut and Jobs Act. Surprisingly, I was really surprised this didn't go away because it's part of the hated Obamacare. It's was one of the high income taxes used to fund the government subsidy for low income people and middle income people's health insurance. So this is the law. The cap has changed for 2018, obviously, but really nothing else changed as far as FICA on the Tax Cut and Jobs Act. I will tell you that it is first and foremost in the House of Representatives that they are taking a look at pretty significant cuts to Social Security and Medicare in this current Congress. That is one of their one of the goals after getting the Tax Cut Act through. So stay tuned. We might be having a very different conversation a year from now. This is just, I think I've talked to you about this before. There's all this, kerfuffle about, oh my gosh, Social Security's going broke. What's going on? It's being mishandled. It's not that, I'm not going to comment on whether it's mishandled or not, but the bottom line is there's just less workers, right? When it was originally, or a couple years, 12 years after it was originally introduced, there were 16 people working for every one retired person. Now there's something like 4.8, and the projections are, that we're shrinking in population, right? We're not even replacing ourselves in the United States. That there's just less and less workers and more people retiring. It's just a demographic trend. There's nothing to do about that. It's just a fact. So the reality is for the fund to remain actuarially sound, in other words, fiscally solvent, you've either got to raise the taxes, raise the cap, or decrease the benefits, or some combination thereof, right? So what's the most palatable? Well, if you're on the left side of the political realm, you're more apt to raise taxes and not touch the benefits. If you're on the right side of the realm, you're more likely to keep taxes the same and reduce benefits. So, we'll see what happens. Okay, so it gets a little tricky to calculate FICA when people are hitting the cap. So I'm going to walk you through the steps. We're going to practice a couple of these because we need to figure out how much FICA to take from people's paychecks. So I've got a person here, she earns $138,000 a year, and she's paid semi-monthly, so how many times a year? 24. And I've got to tell you what her pay dates are, because this would be different if she was paid on the 1st and the 15th. She's paid on the 15th and the 30th of each month, so her first paycheck of the year was Jan 15. And now I'm paying her December 15th payroll. How much FICA do I withhold? Step one, and I want you to write out all these formulas. Step one, what is her gross pay every time she's paid? Just calculate, what is her gross pay each time she's paid?
$5,750.
Yep. The next question, and this one is the pivotal one, calculate her year-to-date prior gross. In other words, how much had Tamara earned before the December 15th paycheck? So step two is calculate her prior year-to-date gross for the whole year. Sounds about right. How many times was she paid? 22 times. So that's really the key, is you've got to figure out how many times the person was paid before today's payroll. And that's why you have to know when in the month I pay her, right? So she was paid 22 times before today. So what's going to happen on this paycheck? She's going to cap. In other words, on this paycheck, she's going to straddle the cap, right? So your question is, how much of this paycheck is susceptible to FICA? Right, the difference between what she's earned so far and the cap. Right, so she's earned 126.5 so far. We stopped doing FICA at 127.2. So now you can figure out her FICA. So obviously you're taking different amounts for the OASDI and the HI, right? Because the OASDI caps, but the HI doesn't. So in total, 4340 plus 8338, she's going to pay 126.78 out of this paycheck. And her employer's going to match, right? Can you super easily tell me how much FICA she's going to have taken out of her check on her last paycheck of the year, December 30th? Yeah, just the 8338, right? Because she's done. Once you cap for OASDI, you're done. Make sense? Same 3 steps will get you to it every single time. What's their gross? How much have they earned before today? Are they paying full FICA? In other words, they're not going to cap on this paycheck. Are they straddling the cap on this paycheck, or are they past it and you're only taking the 1.45? And then you got to pay attention if you're getting towards the 200, right? All right. I'll let you do this one. Sambit earns $225 a year. He's paid monthly. And I want you to figure out the FICA for his November 30th payroll. Gosh, I think I could squeak by on that. So what, 10 payrolls before today? Okay, I hope I did this right. There may be more to this than I picked up. Okay, so nothing for OASDI, right, over the cap? How much will be taxed for HI? Okay, I did do it right. Okay, so how's that for confidence in yourself? So there's 2 pieces to the HI for this one, isn't there? The whole amount is taxed for 1.45%. And then the amount that goes over the 200,000 has got that additional 0.9. So and the one thing to keep straight in your head is with the cap, it's up to that amount. With the 200 grand, it's the amount over that amount, right? Does anybody need clarification about that? So cap, you're calculating up to the 127.2. With that tack on 0.9, you're figuring out the amount they went over the 200,000. Are you starting to get a feeling for why payroll is a very specialized area of accounting? And it's being compensated as such more and more. It used to be like a payroll clerk was just like the super redundant, and now really bringing in all these different elements and adding in, pension contributions and HSAs and, 529s and there's, flex benefits, cafeteria plans. There's a lot going on. And it's being recognized in wage base. Okay, can we keep going? Betsy, you okay? And you can go back, of course, at any point in time. I'll post the lecture as well as the slides are on. Oh, and then the other question is how much will the employer's HI be? Just the 271.88, right? Because employer doesn't match that 0.9 tack on. All right, SECA, Self-Employed Contribution Act. Let's see if we can do the numbers in our head. So OASDI for SECA is how much? So that's everything. So just the OASDI is 12.4 up to 127.2. Medicare is 2.9, but then it jumps up to 3.8 for over 200,000. Or married filing joint 250. I think they don't even make that point in the book, and so I think you're just assuming for every example that we're doing that they're single. Okay, so first question is, what do you pay SEC on? So say that I'm an author and I get $40,000 of royalties this year for a book I wrote. Is that what I pay SEC on, that 40 grand? Why not? You're shaking your head no. Why not, Kristen? Yeah, you got to ask me, what can I write off against that? Actually, authors generally don't have a lot to write off, but I'm at least going to take stuff like, the cost of my MacBook and my internet connection and, really for authors, unless they travel with their product, there's usually not a whole ton of write-offs. But at any rate, the point is whatever you can think of, your home office you get to write off. You're going to take that against and reduce that 40,000. So the point is it's net earnings. It's not gross billings, it's net earnings. Plus the distributive share of partnership income. Okay, what does that mean? That means that if I'm in a partnership, say that Shelley and I shoe horses and train horses together. Do you like horses?
Sure.
Sure. Okay. I love horses. I was either going to be a ballerina or an equine veterinarian, and I ended up an accountant. Really? So dull. But I still love dancing and horses. So there you go. And we're in a partnership together, and last year our net earnings were $40,000, $50,000. Let's use a different number. Okay, net earnings of $50,000, and we sit down at our partners meeting at the end of the year and we decide we're not going to pull any cash out of our partnership this year because we want to save to build our own indoor arena, right? So we don't even take the cash. We're 50-50 partners. Do I have to put that 25 grand and pay FICA on it on my tax return? That's what distributive means. We didn't actually distribute it because we chose to leave the cash in the partnership to save money to build the indoor arena. But we could have taken it. That was my distributive share of the net earnings was $25,000. So I'm going to have a pretty, a couple $1,000 tax bill on money I never got. That's what distributive share is. And believe me, this is not an easy thing to explain to your tax clients. But I didn't take the cash. I know you didn't take the cash, but it's distributive. What the hell does that mean?
So have to pay taxes on it again?
No. So in, like, say in a subsequent year, so say that happens again next year, we make another 50 grand and now we've got 100 that we've paid taxes on, but we haven't touched it. And then in the third year, it's like, great, we get a piece of land, we pay the 100,000 and we take a mortgage out for the stables. We're not going to pay anything when we pull the 100 out for the down payment on the land because that's already been taxable income. Does that make sense?
Yeah. It's pretty rough, but yeah.
I mean, it is rough, but think about the propensity from say that I'm, in Texas and I've got oil and gas royalties all over the panhandle. Is it really fair that I can earn a ton of money? I don't need to take the cash, but I'm generating tons of net worth for myself and not paying any tax on it. And then say I die with that net worth, that all goes to my heirs on a stepped up basis and the government never got to get any tax on any of that increase in net worth. Whereas you and I just go to work, right? We're always going to pay 7.65% on every dollar that we earn. So, I mean, it totally depends upon where your mindset and your pocketbook is. But I don't think it's particularly fair that you could hold on to that your whole earnings and then distribute it to your kids tax-free and never have to pay tax on it. So, of course, I don't say this to my clients. I commiserate, oh, that's so sad. Okay, if you own more than one business, so this is kind of nice. So let's say that we've got our equine business, and then we also I own a little quilt shop and she owns a little bakery. And let's say neither of those do very well, and we have losses in those businesses. We can take our 25 grand each from the equine business and net the loss from the quilting shop or the bakery against that and bring that 25,000 down to whatever that would be once it's netted. So I definitely have clients that do that. Now what clients will want to do is they'll want to take their hobby and convert it to a business. Okay, how does the IRS define a business versus a hobby? Well, they'll make revenue. They'll earn some revenue, but they won't earn any income. So I love to travel. I travel internationally, fairly good photographer, take a couple pictures while I travel. Every now and then somebody wants to buy one. Here's $500 for your photograph. So I'm going to write off my $10,000 trip to Cambodia. That's a hobby. I earned revenue. I made $500 on the photograph. But I spent $10,000 to earn the $9,500. That's not a business, that's a hobby. So you have to show that you actually earn income in 2 out of the last 5 years. And I will track that for people. They are always telling me, my interior design business is I'm like, it's not a business. You're married to a cardiologist, which is why you can go do design for fun on the side, but you're losing money. You can't write that off against his W-2.
So you have to make income.
You have to earn income 2 of the last 5 years. And I just have like a worksheet in the front of my clients' folders where this possibly pertains to them, where I just track that. So whenever they start, but, and I'm like, no, it's right here.
It's a lot every year.
Yeah. Or you maybe made a little bit 1 year, but that's only 1 out of the last 8. And the tax code very clearly, 263A says 2 out of the last 5. So.
Have income from there, then I'll have super losses, but you have
Right. Yeah. Okay. Good point. I've never really had anybody take it to that extreme. And it's, it is one of those areas too of, kind of gray areas of the tax law. I'll tell people that come to me, I'm a sole practitioner. I don't have anybody else to run things by because I just sit by myself in my home office. So if you come to me and you're really high net worth and you want a super aggressive CPA, I'm not your person. I'm kind of like, I do middle and lower middle class folks. I try and save them a few bucks here and there, but I don't go to tax court. I don't practice in front of the appellate judge, judicial systems. If you want that kind of CPA, you don't you don't want me. So, okay. And I treat my own tax situation like that too. I know. I don't really mind paying taxes. I think it's a privilege to live in this country, and I'm not like polarly opposed to paying taxes. Okay, with that said, here is the recap on SECA. Okay. So here's where it gets a little tricky. And this describes an awful lot of people in this valley is I've got a job, but that's not enough to sustain me, so I do a little something on the side. Or maybe it sustains me, but I want to, have a little bit more life. So I have a side gig. I have a tax business. I walk dogs. I do some editing, whatever. So both your W-2 and your SE income, and SE income stands for self-employment income, both your W-2 and your SE count towards that 127.2 cap. Now, your employer's always going to take the full amount of FICA against your wages, right? So really the question is, what happens, say, I make $70,000 as a litigator for a law firm in town, and then I've got some clients on the side and make another 60. So between them, I've made 130. My boss has taken FICA on the first 70. Now my question is, how much SECA do I have to pay on that next 60,000? You with me? So on that 60, the first thing I have to say is, between the two of them, am I going to go over the cap? And I am. I'm going to make them 130. So part of that 60 is going to be taxable for 12.4. All of the 60 is going to be taxable for the 2.9. Right? Okay, so let's try one of those. Oh, and then this, let me just finish this. So it's telling you here that when you have self-employment income and you're a sole proprietor, or you're a single member LLC. What's an LLC? A limited liability company. Like, for example, that's what I am. I'm Lisa Swallow CPA LLC, PLLC, Professional Limited Liability Company, which means I'm a separate entity. I've got to have a separate ID number. And if I really screwed up and you wanted to come after my assets, you would be limited to the assets of my tax business. You couldn't come after my personal assets. Okay? But it's just me, so I'm a single member LLC. Single member LLCs and sole proprietors fill out something called a Schedule C that attaches to your 1040 and reports your income and loss or revenues and expenses for your business. And then with that, which is where you actually calculate the SECA, is something called the Form SE, self-employment. Okay, and then that very last little bullet says you must include SECA in quarterly estimated payments. What's a quarterly estimated payment again?
You're making the payments to the tax, or to the Department of Revenue
So Department of Revenue's Montana, right?
and the IRS.
Yeah. Those are called ITs, weirdly. And for the IRS, they're called 1040 ESs. And those you have to send the two governing entities up here your estimate of 1/4 of your tax liability for the year, 4 times a year. April 15th, June 15th, October 15th, and January 15th the next year. If all you are is self-employed, right, if you don't have a job, that's all you do, or you're a member of a partnership, you need to learn how to calculate these so that you get your taxes in on a timely basis. At the end of the year when you file your tax return, you get caught up, right? Like say, I really owed $8,000, but I only gave them 4 during the year. I'm going to pay that other 4,000 with my tax return, but then I'm also going to be penalized on that because I didn't pay in enough with my quarterly estimates. What they're saying here is when you make your quarterlies, you're not just paying state income tax or federal income tax. With your 1040 ESs, you've got to calculate your second tax and your federal income tax. So for example, I have a lot of you kind of get into these niches, and I've got a lot of tradespeople, drywallers and floor installers and finish carpenters. And a lot of these guys and gals, live on not much, $15,000, $20,000, $25,000 a year, right? So then you get to the end of the year, you can kind of just do in your head. I mean, if I'm earning 20 grand a year and I owe 15.3% for SECA, right, before I even get to my federal income tax, that's $3,000. You with me? How many people that are finished carpenters or drywallers have got 3 grand sitting in their checking account? Like, none of them. So then it's like, oh shit, I can't pay my taxes this year. So then I gotta get them on an installment plan to pay their back taxes, but they should be making their current taxes. And it is just an ugly, never-ending cycle. So sometimes I'll get somebody that's just starting out, and then I can get them on board, which is you've got to set up a separate bank account, and every time you get a check, and I'll calculate it for them, you've got to put 28 or 30% of that into an account called estimated taxes, right? And not touch it. And there's people that are disciplined enough to do it. It's a tough one to get people to do, but they're just going to get into a never-ending cycle if they don't. So you've got to make your quarterly estimated payments, and they've got to have the money there every quarter to do it, right? Okay, so I don't like that the answer's up there. Let me just put this up on the board. So let's say that what was this one? Okay, my W-2 is 138. Oh, gracious. 760. And then I also had SE income of 14.5. I want to know, whoops, wait a second. I want to know the total amount that I'm going to be responsible for SECA on my self-employment income. I don't really so much need to worry about this with my quarterlies because my employer's taking care of the withholding, right? So this is what I'm concerned about. How much am I paying in for quarterlies on that 14.5? Oh, Betsy, thank you for that note. I did open the solutions to Chapter 2 for finance. Yeah, thank you for the note. I was going through the homework and I'm like, oh, good girl. I never would have remembered. That's pretty straightforward, right? She's capped. So all we're doing, that should be a really easy calculation, 14.5 times 2.9. Didn't get to the 200 grand. It's over the 127.2. Right? And then obviously I'm going to need to calculate our federal income taxes on that. Add that to the 420 and divide by 4 payments. I'm simplifying because a lot of people, their income's really cyclical, right? Like for me, tax season, I earn everything in 10 weeks and then maybe do a tiny bit of consulting the other 9 months. So I'm kind of simplifying it. But for our purposes, let's just get like the broad brush strokes. Okay, so let's try another one. Questions?
So now you only be sending in
420.50
But
plus.
you send it in quarterly?
Yes.
You send it in, okay.
Yeah,
So you're
and-
sending 105.13
Right. I'm gonna send him 42050 plus the federal income tax. And again, like I said, I'm simplifying this, there's some more rules surrounding this. If it doesn't get to a certain threshold, you don't need to bother, as compared to last year's tax liability.
Okay.
But for our real purposes, the answer is yeah. Okay, wait, what's going on this one now? 68,250. Okay. So in this situation, the W-2 is $68,250. 68,250, and the SE income is 94,500. So I'm a consultant, I work for a financial products firm, they pay me $68,250, and then on the side, I write a financial newsletter that's gone viral, and I make almost $100,000 of SE income on that. Now, you got a lot of things to pay attention to here. So the key here, obviously, is only part of it is susceptible to the 12.4, right? Because between the W-2 and the SE income, it caps. The whole thing is susceptible to the 2.9. And we don't have the $200,000 issue. And obviously, in this case, Preben is both the employee and the employer. That's what SECA is. Okay, we ready to move on? All right. SS4 and SS5. Anytime you see something starting with an SS, that means it is a Social Security Administration form. And SS4 is required to get something called an EIN. You will also hear this called an FEIN. It's differentiated from an SEIN, which is a state employer ID number. An EIN or an FEIN has got the same number of digits as a social, but there's just one dash in it. So it's like, right, that's an FEIN. And basically an FEIN is to your business as your Social Security is to your life. You get an FEIN if somebody dies and they've got an estate. You get an FEIN if you're a trust. You get an FEIN if you're a partnership or an S Corp or a C Corp, or like me being a sole member LLC. Okay? Or even if you're just a sole proprietor and you have employees, then you have to get an FEIN because you're going to pay payroll taxes. An SS5 is what you file to get a Social Security card. And of course, this has changed significantly. I don't think there's anybody else in here that remembers this, but like when I was a kid, you got a Social Security card when you got your first job. And it was like a coming of age thing. It was really exciting. I got mine at 14, so I could work at the New York Cake. And yes, I had a weenie on my hat. It was very cute. $1.87.5 an hour was minimum wage. 1.875. Oh my God. I just think it's just funny to say, but that was my first job. But now, of course, you go home from the hospital with an app for, with an SS5 because you can't claim your child on your tax return. You can't get a dependency exemption, you can't get child tax credit, you can't get earned income tax credit. I mean, so newborns are, you get a Social Security card straight away. Okay, so SS4, SS5, those are important. So this is what we're going to be focusing on Thursday. I'm going to give you a little introduction today. Maybe we'll have a time. We'll probably have some time to look at it. So it's called a 941. So the way everything, all the different kinds of taxes go, FICA, FIT, SIT, SUDA, FUTA, whatever, is you've got to figure out what the tax is. Then you've got to deposit it, right? You got to get it to the agency. And then you have to do something to reconcile it. In other words, report the wages and the taxes and make sure that everything evens out, right? So for Social Security taxes for FICA and SECA, we file a form called 941. It's a quarterly federal payroll tax return. And there's tons of important information just right in the title. How many times a year do I file this thing? 4, right? That's what quarterly is. Every 3 months is 1 quarter. Second important thing is that the word federal is in the title, which means you never, ever put state taxes on it. It's purely federal. And what I'll have you say when we talk about 941s is it's FICA, FICA, FIT. So you always remember to double FICA. A 941 reports or reconciles FICA, FICA, FIT. I told you where you can download it, and they are due on the last day of the month following the close of the quarter. So right now, what quarter are we in of the year? First quarter. When does it end? March 31st. So the first quarter 941 is due April 30th. And then the second quarter ends on June 30th, and that one's due on July 31st. The third quarter ends on September 30th and is due on 10/31. And the last quarter ends on 12/31 and it's due 1/31 of the next year. So in this, it doesn't seem that confusing at face value, but the rules for depositing the taxes are different from when you have to file the tax return. What the heck am I talking about?
Sending them money.
Yes, sending the money in. So if you guys all work for me, or you're the university that runs a $8 million payroll, you're not waiting a whole quarter to send the money to the IRS, are you? So you've got different deposit rules than you do when you actually file and reconcile. So these rules are for everybody. These are when the 941s are due. It doesn't matter if it's you sitting with your, lemonade stand and one employee 2 hours a week, or you're the university. The deposit rules are what's different. Okay, if you're really, really tiny and you owe less than $1,000 of FICA FIT in a whole year, you can just wait and file a 944 instead of a 941. And that's only due annually. And lastly, that last big bullet is if I am retired and I'm getting pension checks, or I'm getting distributions from my IRA or my 401k, I'm going to have to pay income tax on that. I'm not going to pay FICA on that, am I? When I pull money from my pension or my 401k or something like that, I don't have to pay FICA on it, but I have to pay federal income tax on it. Okay? And in order to report that, you have to file a Form 945. So there's really 3 things you need to know here. Almost everybody files a 941 if you have employees. But if you're really, really small, you can get by with a 944. And if you're doing something like pension or 401k distributions, IRA distributions, you file a 945. Okay, let's talk about the deposit rules. These are a little bit wonky. Okay, I'm just going to say it and then I'll show it. So, first thing you need to know is, as a new employer, say you're just starting a business and you're like, oh gosh, I don't know how often to deposit my FICA FIT. Okay. The first year, you're always going to be monthly. That's what all new employers default to. Then at the end, or towards the end of that first year in November, you get a letter. It's all electronic now. And they tell you what you are in the future. And they're going to tell you one or two things. You're either monthly or you're semi-weekly. If you're monthly, to deposit by the 15th of the next month. If you're semi-weekly, you really only got a couple days to get it in the bank. And the way that schedule looks, if you pay between a Monday and a Wednesday, right, if your actual physical payday is a Monday, Tuesday, or Wednesday, you need to deposit by Friday. And then if you don't pay Monday, Tuesday, or Wednesday, then what's left is Thursday through Sunday, right? And then you have to deposit by the next Wednesday. So it's really like basically 2 or 3 business days. That's called semi-weekly. And obviously, if they want you to do this versus a monthly schedule, it's because you're bigger. There's more money at stake. They don't want you to hold on to the money for a whole month. They want it in a couple days. Now, that's the basic rule. With that, there's 2 exceptions. But let's just get the basic rules down. So FICA FIT is always deposited together. Each November, the IRS tells you whether you're going to be monthly or semi-weekly in the upcoming year based upon what they just looked back and saw on their records for the prior year. If you're monthly, you pay your FICA FIT by the 15th of the next month. If you're semi-weekly, this little chart is what that says. And the way I remember this is MWFW. It's like a little pattern.
That's different than what it says on the screen now. Wednesday, Thursday, Friday, do the following Wednesday, Saturday, Sunday.
Oh, gosh, I wonder if my pattern doesn't look like it usually does. Thank you. Oh. Wednesday through Friday, yeah. Wednesday, that's the pattern, WFWF. Sorry. Yeah, that's the pattern, WFWF, and then just plug that in. If you don't pay on Wednesday through Friday, you pay on Saturday through Tuesday. It's like my pattern doesn't really look like a pattern in the first one. Okay, so basically same thing though. It's basically like 2 or 3 days business. And then the exception is, if you're really big or really small, you don't have to comply with this. So they tell you you're one or the other, except for if you're really big and you owe more than $100,000 on any one payroll, a FICA FIT, you only have 24 hours to get it in the bank. So like when the university runs payroll, they're not going to let you hold on to, $900,000 for 3 days. They want it transferred immediately. Obviously, somebody that's running giant payrolls, they've got what's called an EFT system, an electronic funds transfer system, and it immediately is zapped right when the payroll's zapped, right, from their account. So $100,000 if you're really big, that's a 1-day exception. And if you're really small, so you're not the small guys, so small that it's 1,000 or less, that's a 944. But if you're like, this describes a lot of people in this valley, less than $2,500 in a quarter, you can just wait and send the deposit in with the actual 941 tax return. So all quarter long, say I owe $600 a month. So all quarter long I owe $1,800. Is that a good thing or a bad thing if you're a small business? I mean, technically it's good because you get to hold on to your own money longer. What's the bad thing about it?
It's like kind of what you were talking about with the carpenters and stuff. It's like
They spend it. You spend it if it's sitting in your account. Be the equivalent of you or I. We get our paychecks, and then it's like once a quarter, you have to pay your rent instead of once a month or something. And it's like, so you have to constantly remind yourself when you're looking at your bank account, oh, there's 2 months of rent in there, So for people that do this, again, I try and get them to set up another account and move those funds in so that it's sitting there. But really with my small clients, I try and get them to just deposit once a month because it's just hard. Okay. There's slightly different requirements if you're an ag employer or a household employer. In other words, you have like a nanny or a chef or a chauffeur or something. Not going to get too deep into those, but there's different requirements. Basically, for years and years and years, we had paper coupon books, and you ripped out the coupon and you wrote a check and you put it in the mail and put a stamp on it. It was all very quaint. Then we went to where you would go stand in line at one of the electronic or one of the federal depositories in Missoula with the coupon and your check, and they would automatically post it for you. Well, of course, now we do EFTs, electronic fund transfer. So when you get set up, it's called EFTPS, which is the Electronic Federal Tax Payment System. Okay, and when you get set up as a new employer, you file your SS4, you get your FEIN. You also have to get clearance to do EFTPS. And like little tiny businesses can still do it manually, but why would you? So you complete this form. This is one of the things some of you are in the entrepreneurial program. When you're setting up your own business, this is one of the things that you have to do in addition to getting your SS4, getting your FEIN. And you do the dry run to make sure that the money transfers from you to the IRS. You're also going to go ahead and set up with the Department of Revenue simultaneously. And then really a lot of your taxes, or all your taxes, can be transmitted electronically, and it's just easier. This isn't so important. Okay, this is what we're going to be working on Thursday. I'll leave you there. Make sure you've got the notes about where we're heading. I will open up the review for the test right now while I'm thinking about it. And make sure you get Chapter 3 read, get your 941s downloaded, and we will see you on Thursday. Stay warm. Even my puppy's cold.
How are you feeling?
I'm still feeling raspy. My throat sounds, I didn't realize how crappy I sounded, so I started talking. I'm feeling better. Sleeping a ton. I'm sleeping like 10 hours a night.
Well, I don't had it until like Tuesday last week until she still was running anywhere. So
I was so miserable. I mean, I did the whole thing. I showered, I got dressed. And then I'm like, this is stupid. I mean, I can just barely even hold my head up.
yeah, it's horrible.
But I hate missing school.
Right.
You
Well,
know.
my daughter missed my coffee.
Ugh.
I was like,
And what do you do as a single mom?
my parents helped me out and watched her for the few hours I was in school.
Yeah.
I just would go right home after school.
Oh, thank heavens.
And knock on wood, my 4-year-old didn't get it, and I didn't get it, which I'm like, how long is it?
Right?